Shock jobs report reveals recession alert, AI's role in rising unemployment. The recent jobs report has sent shockwaves through Wall Street, raising alarms about a potential recession and hinting that artificial intelligence, AI, might be contributing to rising unemployment, according to JPMorgan. This report revealed that payrolls increased by a mere 73,000 last month, significantly lower than the anticipated figure of around 100,000. Additionally, revisions to previous month's data were stark. May's job growth was revised down from 144,000 to just 19,000, and June's figures were slashed from 147,000 to a mere 14,000. As a result, the average job gain over the last 3 months has plummeted to only 35,000. It's important to note that these disappointing job numbers do not necessarily indicate widespread layoffs. Other indicators, such as weekly jobless claims and monthly job turnover surveys, support this notion. Furthermore, wages and work hours continue to rise, which is a positive sign. However, JPMorgan economists pointed out that the optimism from these figures is overshadowed by a significant slowdown in hiring, which they describe as a stall speed alert. In the private sector, hiring has dwindled to an average of just 52,000 jobs per month over the last 3 months, with sectors outside of health and education showing stagnation. The absence of any evidence suggesting a surge in unwanted separations due to immigration policies further indicates a cooling demand for labor, according to their analysis. JPMorgan has consistently warned that a decline in labor demand of this scale serves as a warning sign for a recession. Typically, companies maintain their hiring momentum even during perceived temporary slowdowns in growth. However, when labor demand decreases alongside a growth slowdown, it often foreshadows a more significant contraction. Currently, the broader economic indicators still reflect growth, albeit at a decelerating rate. The GDP showed a surprising rebound in the second quarter, reaching 3%. However, a measure that excludes foreign trade and focuses on domestic demand suggests a slowdown. Projections for the third quarter from the Atlanta Fed's GDP tracker indicate a further deceleration to 2.1%. JPMorgan cautioned that the sluggish pace of job growth is unlikely to support sustained income increases or bolster consumer confidence, which had recently shown signs of recovery. Moreover, the U6 unemployment rate, which includes individuals who have not actively sought work recently but are still interested, as well as those involuntarily working part-time, has risen by 0.4 percentage points this year. In contrast, the headline unemployment rate has remained relatively stable, fluctuating between 4% and 4.2% for over a year. Before the recent report, this stability had created an impression of resilience in the job market, even amidst significant tariff increases imposed by President Trump. JPMorgan expressed that the current state of job creation can no longer be accurately described as solid. Coupled with the ongoing challenges from the trade war, the latest news reinforces their belief that the Federal Reserve is edging closer to easing monetary policy. In a separate analysis, JPMorgan highlighted additional insights from the jobs report that suggest AI is influencing the labor market. For instance, payrolls in the professional and business services sector have been on a downward trend, decreasing by 14,000 last month. Additionally, the unemployment rate for college graduates has risen from 2.5% to 2.7%, while the overall unemployment rate increased slightly from 4.1% to 4.2%. JPMorgan noted that a significant portion of the rise in unemployment last month can be attributed to new entrants into the job market. This follows earlier concerns regarding AI's potential to diminish the availability of entry-level positions, which are crucial for recent graduates seeking to start their careers. However, economist Brad DeLong recently argued that the difficulties faced by young job seekers are primarily due to widespread policy uncertainty and a sluggish economy, rather than the rapid advancement of AI technologies. He pointed out that uncertainty leads companies to postpone major decisions, including hiring, in an unpredictable policy landscape, which has been affected by the erratic nature of Trump's trade policies. This cautious approach is particularly detrimental to those at the beginning of their careers who depend on a steady stream of entry-level job opportunities to gain a foothold in the workforce. In conclusion, the 2025 Fortune 500 list has been introduced, showcasing the largest companies in America. Explore this year's rankings to see how the economic landscape is evolving. U.S. job market slows down. What the July jobs report means for the economy. When it comes to the health of the U.S. economy, few indicators carry as much weight as the monthly jobs report. So, when the Bureau of Labor Statistics released its latest findings for July, it painted a picture that many might find alarming, raising critical questions about the road ahead. The U.S. economy added just 73,000 jobs last month, far below what analysts had anticipated, and revisions to earlier months revealed an even more troubling trend. But here's where it gets controversial. Could this be the start of a deeper slowdown, or is it merely a blip on the radar? The July numbers fell short of the already modest Dow Jones estimate of 100,000 new jobs, signaling weaker than expected growth in non-farm payrolls. To make matters worse, job totals from June and May were revised downward by a staggering 258,000 positions combined. For context, June's figure dropped from 147,000 to just 14,000, while May's count plummeted to a mere 19,000, a revision so dramatic it has sent shockwaves through financial markets. Stock futures tumbled further after the announcement, and Treasury yields dove sharply lower. Adding another layer of concern, the unemployment rate ticked up to 4.2%, aligning with forecasts, but still marking a notable shift. A deeper dive into the data reveals some unsettling details. The household survey, which helps calculate the unemployment rate, showed a steep decline of 260,000 workers, dragging the labor force participation rate down to 62.2%, its lowest point since November 2022. Meanwhile, a broader measure of unemployment, which includes discouraged workers and those stuck in part-time roles due to economic necessity, surged to 7.9%, the highest level seen since March. And this is the part most people miss. Long-term unemployment is quietly worsening. The average duration of unemployment climbed to 24.1 weeks, the longest stretch since April 2022, and the number of individuals out of work for over 27 weeks reached 1.82 million, the highest tally since December 2021. This accounts for roughly 1/4 of all unemployed Americans, highlighting growing challenges for those struggling to re-enter the workforce. Despite these red flags, there were pockets of resilience. Healthcare once again proved to be a bright spot, adding 55,000 jobs and accounting for nearly 3/4 of the total growth. Social assistance chipped in another 18,000 positions, while retail and finance contributed modest gains of around 16,000 and 15,000 jobs, respectively. However, other sectors faltered. Federal government employment continued its downward spiral, shedding 12,000 jobs in July alone and 84,000 since January. Professional and business services also took a hit, losing 14,000 positions. This is a game-changer jobs report, remarked Heather Long, chief economist at Navy Federal Credit Union. The labor market is deteriorating quickly. Such sentiments echo concerns among policymakers and economists alike. Atlanta Fed President Raphael Bostic acknowledged the uncertainty, stating, "In many ways, this is about slowing down. And now the test we have is really to figure out to what extent is this slowdown likely to persist and get us into a more troublesome position." For the Federal Reserve, this report could tip the scales toward action. Futures traders are now pricing in a 75.5% chance of an interest rate cut at the central bank's September meeting, up sharply from just 40% before the release. This marks a significant shift, especially given the Fed's recent decision to keep rates unchanged despite mounting pressure from President Donald Trump, who has repeatedly demanded aggressive cuts. In fact, Trump took to social media shortly after the report, slamming Fed Chair Jerome Powell as a stubborn moron and calling for immediate intervention. But let's zoom out for a moment. While the labor market may be showing cracks, the broader economy isn't collapsing, at least not yet. Second quarter GDP grew at an annualized pace of 3%, surpassing expectations. However, this headline figure masks underlying weaknesses, particularly in consumer spending, which remains sluggish. Much of the GDP boost stemmed from adjustments following Trump's tariff announcements rather than robust organic demand. So what does this all mean for the future? Are we witnessing the early stages of a prolonged downturn, or will proactive measures stabilize the situation? White House officials argue that existing policies, including trade deals and tax reforms, will help reignite momentum. Stephen Miran, chair of the Council of Economic Advisors, admitted during a CNBC interview that certain aspects of the report were disappointing, but emphasized the administration's commitment to fostering recovery. Still, lingering uncertainties loom large, with ongoing trade negotiations and escalating tariffs casting doubt on businesses' hiring plans. The path forward remains unclear. Will companies step up their recruitment efforts, or will caution prevail? And how should the Fed respond to balance supporting growth without fueling inflation? As always, your thoughts matter. Do you think the Fed should heed Trump's demands and slash rates immediately, or is patience warranted? Is this jobs report cause for alarm, or simply a temporary hiccup? Share your perspective in the comments below. Let's unpack this together. Trump fires BLS commissioner after shocking jobs report. Economic stagflation fears rise. A storm is brewing over the economic horizon as the latest jobs report casts a long shadow on the Trump administration's economic legacy. Friday's data revealed a staggering 106,000 job additions over the past 3 months, a figure far below expectations and raising urgent questions about the health of the labor market. But here's where it gets controversial. The president's explosive reaction to the numbers has ignited a firestorm of debate about the integrity of the data itself and the real cost of his trade policies. Let's unpack the numbers, the fallout, and the simmering tensions that are shaking both Wall Street and Main Street. The Bureau of Labor Statistics, BLS, report painted a grim picture. July's job gains of 73,000 were a far cry from economists' predictions of 100,000. Even more alarming were the downward revisions to previous months. June's tally dropped from 147,000 to 14,000, and May's fell from 144,000 to 19,000. The Labor Department called these revisions abnormally large, citing changes in data from state and local government education sectors. Critics argue this isn't just a statistical hiccup, but a sign of deeper economic cracks. Trump's response? A swift and unprecedented move, firing BLS Commissioner Erica McIntyre, whom he accused without evidence of politicizing reports ahead of the 2024 election. This decision has sparked fears that future economic data could be manipulated, eroding trust in the very metrics that guide global markets. Reliable data is the backbone of our economy, warned Harvard economist Jason Furman. Even if Trump can't fake the numbers, the damage to public confidence is already done. Markets reacted with panic. The Dow Jones plummeted 542 points in its worst day since May, while the S&P 500 and Nasdaq Composite both fell by over 1.5%. Investors are now bracing for further turbulence. This isn't just a bad report, it's a warning shot, said Zacks analyst Mark Vicker. The labor market is weaker than we realized. The administration has doubled down on its tariff strategy, claiming these measures will revive American manufacturing. But the data tells a different story. July saw 11,000 manufacturing jobs lost, a sector that's shed 26,000 positions in 2 months. Former Biden aide Monica Gorman bluntly stated, "We're not seeing a renaissance, we're seeing a retreat." Meanwhile, tariffs are hiking prices for consumers, with personal consumption inflation at 2.6% and the CPI at 2.7%, the specter of stagflation. Rising unemployment and prices looms large. Trump's feud with Federal Reserve Chair Jerome Powell has only deepened the chaos. After months of publicly berating Powell, the president now demands the Fed cut rates and save the jobs, even as his tariffs drive up costs. Economists like Douglas Holtz-Eakin argue this is a dangerous game. He's blaming Powell for the pain his own policies are causing. And this is the part most people miss. The Fed's recent vote to keep rates steady included a rare double dissent, a sign of internal fractures. Many now predict a September rate cut, with futures markets giving it an 80% chance. But will it matter? The economy is slowing. With GDP growth dropping from 2.9% in 2023 to just 1.2% in the first half of 2024. So where does this leave us? The administration insists tariffs will pay off in the long run, but critics argue the pain is here now. We've been promised steel mills and aluminum factories, says Holtz-Eakin, but those take years. This year, all we're getting is higher prices and fewer jobs. Here's the million-dollar question. Is Trump's tariff war a bold move for economic revival or a recipe for disaster? Share your thoughts in the comments. Are we witnessing the early signs of a recession, or is the economy more resilient than the data suggests? Let's hear your take, and don't forget to consider the bigger picture. In a world of global trade, can protectionism ever truly win? The debate is far from over, and the next few months could decide it all.